sweep, and I think markets are currently priced about like 80% chance that Democrats take the House. But I would urge clients to be a little bit more cautious on that, because generally because like morality is not really trending up in the world, and I think Democrats have been kind of camping on the moral ground, and I think there is a risk that voters, whilst being loud about being moral arbiters, actually end up voting with their purse rather than their heart. And I think that's really going to be the interesting takeaway from today's election.
There is this kind of consensus around the idea that we end up with this split Congress, that the House ultimately ends up going the Democrat way, and the market seem kind of priced around that. My question is, what is the transmission mechanism out of this into the market story? Is it the market looks at this and goes, there's a domestic story here from the United States, we're going to get more infrastructure spending, or whatever it is? Or again, is it the trade narrative that provides that kind of that vector for the markets to latch onto and say, if we do get a red sweep, if we do end up with both houses remaining in the Republicans' hands, that's a trade story rather than anything else?
Definitely. I think there's a domestic story, and on there, I think if the Democrats, if we end up in a gridlock, I think it's probably going to be a bit of an economic disappointment in the short term, but really the big legislative actions has already happened. So I don't think it would be a huge, there would be disappointment in terms of like the 10% middle class tax cut. There might be disappointment in terms of trying to extend the fiscal tax cuts beyond the end of next year, even if that would actually mean that you need to have like 60 seats in Senate, which is quite, for the Republicans, which is quite unlikely. So I don't think it's going to be really a game changer on the domestic side. On the international side, I think we might have like a president that would be like strengthened, and I've actually written today that I think calling a truce with China would actually be like a strategic mistake for the president of the United States. I don't agree with him on many things, but I think that thing is like really a ground where you should be like trying to run a marathon rather than a sprint.
Yeah, longer term view. Juliette, let me ask you about the specifics in the midterms. We're obviously going to see some impact on the US economy depending on the outcome. But will the FOMC this week already be talking about the result, or will the FOMC be ignoring whatever happens today and whatever results we get tomorrow and just ploughing its own course as it has been?
Definitely. I think we've got a really interesting story with the FOMC where really the Powell is focused on smoothing down the boom that Trump has created this year. And I actually think that it is a positive for Trump as a whole, because the big downside of a boom is that it often actually ends up in a bust, and the chances that the bust would happen in 2020, which is obviously a big election year for the US. So I think in a way Trump is really unhappy about Powell trying to smooth his beautiful boom, but I think it would be like ignoring that the bust is likely to happen in 2020 to go against Powell at this point. That's what I expect from the FOMC.
How do you recommend the smart money plays the end of this year here in the United States, let's say in fixed income?
In fixed income, I'm still saying we're going to see real rates continuing higher, and that's really been the big call I've had this year. In fact, the one thing I've been thinking all year is that because of the Fed determination to cool down the US economy, instead of seeing the sort of like late cycle equity melt up, which we normally see at the end of each cycle, we're going to see a real rate melt up. So that means I would continue to recommend selling spikes in equities and continue to look for real yields higher. And that's obviously going to be a problem still for emerging markets, especially when markets get disappointed by Trump calling a truce with the president of China on the 29th of November.
There is an argument floating around that says break-evens are coming down. there is no inflation in the US system, despite what we saw with the wage data. And as a result of which, if you take a look at the break-evens, you should believe that the Fed has over-tightened already and therefore should maybe start to slow down next year. If I take a look at 2-year swaps, then I've got inflation at kind of 2.3%, which is kind of where you'd expect it to be if you want a 2% PCE number. Where do you fit in this debate? Is the Fed over tightening? Is the Fed in front of the curve, behind the curve, about where it wants to be in terms of the dot trajectory that it's pointing to?
So first thing is actually the break-even trade is one I've been recommending all year, and I've been looking for break-evens lower all year.
Isn't that just an oil trade?
Not an oil trade. I think if we saw a big spike in oil, you would see the break-even curve actually flatten down, because you'd get like a boom in the short term, but that actually ends up being deflationary.
Yep.
So I'm actually still recommending part of the reason real yields are going up is also as a consequence break-evens going down. I think the main thing, and one of the main themes that I've been looking at this year, is that central banks everywhere around the world are much less concerned about inflation than they were before. I think, I've written numerous times about that, but central banks are not targeting inflation anymore. They are targeting financial stability, and that's what will extend the cycle in the US. And whether Trump likes it or not, it's time for normalization, and that's a move that we're seeing everywhere. That's a move that we're seeing